I'm going to tell you why I think this time is different and why I'm being more open-minded. So first and foremost, for those of you who are new, a simple explanation of how SKEW differs from VIX. The SKEW index is calculated using S&P 500 options that measure tail risk, or returns 2 or more standard deviations from the mean in the S&P 500 returns over the next 30 days. The primary difference between the VIX and the SKEW is that the VIX is based on implied volatility around the at-the-money strike price. So VIX is at the money, while the SKEW considers the implied volatility of the out-of-the-money strikes. So that's a key thing. While I wouldn't be surprised by some short-term market consolidation now that people are starting to get a little excited, I also wouldn't be playing for it because I still think the pain trade is up based on positioning. The primary reason I'm making this exception is because what the tail risk event traders were betting on was it was a U.S. debt default, so the debt ceiling negotiation failure. It did not happen, so all of their insurance premium went up in flames. And so that's what I think is unique about this situation. And I become way more concerned when SKEW spikes on no news and a background of euphoria, because the implication is that the smart money is quietly getting prepared for wholesale distribution. So an example of this would be last year when the SKEW spiked in 2021, right before the 2022 peak. Everyone was euphoric, and yet the SKEW was spiking in the background. That would be an environment that would scare me a lot more, similar to 2018, but not the current environment. We're not at euphoria yet, and I do think that a lot of this was tied to a U.S. debt default and them not coming to a conclusion.